So thank you very much. Now, for those who are here, we'll proceed. I've started recording class. So we are going to start from subsequent events. The word subsequent basically means that something that follows, right? Something that follows, that is subsequent. So events, events are the activities or things that takes place. So if I say that subsequent events, these are things that follows, they are activities that follow something. So what are we referring to? What are they subsequenting? What are they following? That is the thing now. So number one, we need to know that there are terms that will be used in this particular topic. Number one, they can call balance sheet date, balance sheet date. Balance sheet date or financial year. They mean the same thing, right? Financial year. So if somebody talks about balance sheet date or recalls something, he mentions balance sheet date, that means financial year. Tuko pamoja? So if I say that it happened after the balance sheet date, that means that it has happened after the financial year or end of financial year. Most companies have their financial years ending on 31st of December. Then let's say 31st of December 2020. Now, if the year ends on 31st of December, anything that happens after that, we call it subsequent events. It is an event that follows the year end or the end of year. So this one is a balance sheet date. It is also financial year. 31st, that is the end of financial year or end of balance sheet date. Balance sheet date. Tuko pamoja? So those who are just joining, we have agreed that today we are going to look at two things. I want us to look at subsequent events and then joint audit. So we have started with subsequent event. Under subsequent event, I'm saying subsequent means something that comes after. So what are we referring to? What is it that something is coming after? It's coming after the financial year.
Catalonia, Spain.
Sorry for that. Let me just mute everyone. Okay, so when we are referring to this, we are referring to the events that happens after the year end. Those are what we call subsequent events. Tuko pamoja hadi hapo. So you know what subsequent events. They are events or activities that happened after the year end. But now, there are a lot of activities. You might be an accountant somewhere. The year ended 31st of December. Obviously, in January 1st, 2022 or 2021, there are so many activities that are happening. You have started transactions, or maybe some people open or they go back to work on 5th. So obviously, there are transactions that are happening. But so which one are we referring to? In audit, which kind of transactions are we referring to? Now, we are only referring to the activities that happened after the year end, but they have impact on the financial year's report. They actually have impacts on the end of year reports. This particular year, it started from 1st of January 2020. It ended on 31st of January 2021. But then, after the end of the year, not 2021, but 2020, after the end of the year, there are things that could be happening here. From January 2021 going forward, there are things that could be happening in this new year that has impact. They have something to do with the previous year. Those are now what we are referring to. They are the subsequent event. They are the activities that happened after the year end, but has impact on that particular year. Those are the subsequent events. So which kind of activities are these? The activities that can have impact on the year's financials or the financial report. Let's look at the activities. Examples of subsequent events. And why is it important to audit subsequent events? As an auditor, you need to always be very sensitive and skeptical on subsequent events. You need to audit subsequent events. Why? because they have impact on the financial year. Remember, when you are giving financial statement, you are doing audit, the year ended on 31st of December 2020, for example. Your audit you are going to do on March, probably 1st of March. You are not doing immediately. 1st of March 2021, you are doing audit for the previous year. So it is assumed that since you are there during that period, you should be very sensitive on anything that happened here. From here, going like this, you cannot tell us that you didn't see as an auditor. Anything that happened in the whole of this year and up to the date you are doing audit, you can't tell us that you didn't see, even though they might not be in the financials. But as long as they happened here, but they have impact here, you need to tell us. As long as they happened in the new year here, either January or February or March, early March, before you do audit or at the time you are doing audit, and they have impact on the financial years that you are auditing, then you cannot escape that. You cannot tell us that you didn't know, you didn't see. That one we are saying you are negligent. Now, when you are giving surety, as your report, you're going to sign in on this date. So we are assuming that everything here was confirmed by you, everything that happened. So let's look at some of these subsequent events that you might be referring to. Number one, we are referring to what is called contingent liabilities. Contingent liabilities. Contingent liabilities. What are these? These are liabilities that has happened, but they have impact. They have potential. They can create potential liability in future. These are things that you've done today, but has potential impact in the future. We normally say that in your life, every day you make a decision. Every decision that you make in life has got impact, or it has to come back in future. Ukifanya CPA leo, that means that in future, when you are applying for any job, this CPA is an asset. It will help you. If you make a decision not to do CPA and just remain with your diploma, remember it will impact in you in the future. Those are what we call contingent liabilities. There are things that we are doing today, but will come back as a liability in the future. Tuko pamoja? For example, now, if you have a case that is going on in court, but you are so negligent as a HR manager or the employer, you didn't know that this case in future, you can actually lose it and you're going to pay for it. So it is going on now, but it will have impact in future. Utalipia in future. Then that case that is going on in court, it is an activity that is happening now that can actually result to a liability in future. Therefore, it is a contingent liability. Another contingent liability are the transactions that you're doing today. You are giving somebody money in terms of credits. Amechukua vitu today on deni is going to pay you in future. That future might not come. That person might die, that person might lose job, or the business might not work, or it can just decide not to pay you. You can make a loss in future. Today, it is not a loss, but it's an activity that you're doing that can actually make you have a liability in future. If there are any other loan that you took and you're expecting to pay that loan with the money that you made on credit sales, you can actually fail to pay that loan because even you, the person who owes you money, died or he failed to pay. So it is a liability that results from activities of today, but it will come in future. So those are the things that we are calling contingent liabilities. They are actually, when you now realize it, you can actually realize it after the year end. That's when your eyes open. You realize that kumbe, this one is a liability that I have to pay. But when you look at it, it has something to do with the financial year's transactions, like debts. Somebody has failed to pay you today, you thought he's going to pay, he has died, or he has decided not to pay, he has been declared bankrupt. If he's declared bankrupt, hatalipa. But then that is when you are realizing, kumbe, hii pesa sitapata. But at that time, it is affecting the financial year of last year. In the books of last year, it was one of the debtors that were called receivable. You thought you would receive it. Only to realize today that you are not going to receive anything at all. Then it is a subsequent event. There are events that happened after the year end, but they have something to do with the previous year. So it is an event that happened after. So it is subsequent events. Now, liabilities, we say that the activities that raise or bring liabilities in future. So another one, a good one is court cases. Those are examples of contingent liability. So let me give you an example of subsequent events. These are subsequent events. So the first one is contingent liabilities. An example of contingent liability is a court case. The case that is going on in court today that you can pay for in future, penalties and other payments. Then we have number 2, debts or credit sales. Or we can just call it bad debts. These are examples of subsequent events. So the number 2 is bad debts. Number 3, going concern. We have certain going concern issues that can happen. Last year when the year ended, we didn't have a problem with going concern. Like in 2019, we didn't have a problem with going concern. But now in 2020, COVID came, most business died. So that is when you are realizing that there's a problem with going concern. This kind of hotel industry, it cannot continue. The government has closed all hotels, they cannot operate fully. So most companies cannot continue. So at that time when you're auditing, even though you're auditing for 2019, but because you're auditing in 2020, you look at the future. So there's a problem with going concern. That is a subsequent event. Those are things that you need to disclose in the financials. They might not have financial impact, but they have information impact. You need to tell investors who want to invest in that kind of business that this business is good. 2019, it did well. But we are fearing that going forward, if you put money here, you might be risking because this kind of business cannot operate under the current environment. With COVID-19, the government has refused that you cannot operate. So for the next 1 year or 2 years, we are not sure. So that is going concern can also be a part of subsequent events. What actually are we looking at under going concern? We are looking at the possibilities of the business to continue in a foreseeable future. You need to declare that information in the financial year's report. These are events that happened after the year end, but they have impact on the financial year for the previous year. They have impact on the previous year's financial statements. We also have issues like a strike, potential strike, that is also another one that can also be a subsequent event. Then we have something like loss of key staffs. Loss of key businesses or key clients. So I wanted just to give you an example of things that could have impact in the financial year report. They happen after the year end, but they can have impact. Now, these ones do not have financial impact. So this one, they don't have financial impact, but you need to disclose. Somebody could be maybe interested in, maybe somebody might want to invest in a company, because the financial year's report was okay. But now you need to tell him that right now, Mr. So-and-so has left. And that is why in the financial report, you have to say which directors came in during the year and which ones left. Were there changes in terms of the CEOs? And even in the current year, maybe there's somebody who was working very well, but then there is a disagreement with the management. So any potential investors who wanted to invest because of the current management should be aware that the management changed. They sold the ownership. They are no longer operating in Kenya. They are moving to Uganda. That is what we're talking about going concern. The company cannot proceed. So when you disclose such issues, then now we are saying that it is a going concern, but does not have impact on the financials. It has impact on the information. It doesn't, you didn't need to change anything in the financials, but the information needs to be disclosed. You need to let people know that so-and-so is no longer with us. So-and-so is no longer with us. If you wanted to invest because they are there, you trust them, just avoid that. Now, we have two types of going concern. These are examples of going concern, but we have types of going concern. We have one that is called adjusting event. Adjusting events. And then we have non-adjusting events. Adjusting event and then non-adjusting events. Now, those ones that have financial impact or financial implication that needs to be adjusted. Number 6 is loss of key clients, loss of key clients or key businesses. That is also an issue that has impact on the financial or the report of the previous year. Loss of key clients or key businesses. Number 5 is loss of key management staff. So I was talking about types of subsequent events. There is one that is called adjusting events, and then there's another one called non-adjusting event. Now, when we talk of adjusting, that means that you need to adjust, right? So if I wrote something like 10,000 and you're telling me kindly adjust, I make it 20, it means that I'm going to amend. So the adjusting events, they have financial impact. Examples are court cases. When you lose, you need to know how much are you going to pay so that you can adjust in the financials. That is an adjusting event. They have financial implications on the financial year's report. But then we have some that do not have financial implications, like loss of key businesses, loss of key management. Hakuna pesa imeguzwa. So in that case, it is non-adjusting events. There are events that happen after the end of the balance sheet date or at the end of the financial year, but they don't have financial impact. It is just information that you need to disclose in the financial report. That is how you should treat non-adjusting events. For a non-adjusting events, you only disclose in the financial report. You only let people know. But for adjusting, you need to change the figures, adjust the figures, so they have financial impact. Apart from this, we have bad debts. When somebody has failed to pay you, somebody has failed to pay you. If it was under the reports that you are having, you had reported initially by the end of the year, the accountant gave a report saying that we have receivable 20,000. We have receivable 20,000. But then in January, one of the key clients who owed you 20,000 died. That means that you are going to write it off. It is no longer receivable. You can't receive it. So you write it off. So these debts, or we call them credit sales or receivable, credit sales, which is also called receivable, now move from receivable to bad debts. Now you write it off. That means that you are adjusting. What you are trying to do is to try to make your financial statement be accurate as possible. Whatever was posted, but things have changed, you change so that it reflects the true and fair position of the company. That is our main aim as auditors. We want to ensure that whatever financial we are giving, we have actually adjusted and recommended all general entries to be passed so that at the end of the day, we give true and fair view of the financial statements. That is why you need to tell the management to adjust. As an auditor, you don't adjust. You only advise so that they adjust. You only advise them to adjust. Tuko pamoja? Now, in exam, under intermediate level, if you are asked to define or differentiate between adjusting and non-adjusting events, it might come. And if they tell you, it is very simple. In your level, at your level, they will only tell you to differentiate. Na hii kitu ni rahisi sana. Or they give you a case and they are asking you, is it adjusting or non-adjusting? Hiyo ni kitu umeelewa. Now, for advanced level, they will actually upgrade kidogo. Let's now upgrade. We are now upgrading to catch up with the advanced level. There is a year that they were able to bring such kind of questions. Can somebody tell me the year? When was it set? Adjusting and non-adjusting events? 2000 May. Okay. Yes, Jayona, but let me check. I can check very fast to one. 2000 May 2001. That question. So May 2001. Advanced level. Advanced level, advanced level. Question number 4. Aya, tuko hapo. I remember I was teaching this class. I taught this class audit. Let me see. Question number 4. Don't fear these ones. At your level, sometimes wanaweza leta hesabu hivi. They are so simple. Ukiona hesabu hivi, usifikirie hiyo ni FR. Usiogope, sawa? Aha. Question number 4. So tuangalie hii. Are you able to see the screen? That question paper, you can see it. Question number 4. Haraka teke reply. Are you able to see? Am I still sharing? Are you able to see? Yes, thank you. Okay, so let's look at this at a question. Determine whether the above event is an adjusting or non-adjusting event. Discuss the auditor's responsibility and the audit procedures and actions that should be taken out in the above scenario. 10 marks. Those are 10 marks. Okay, so we have seen the question. Let's now come back to the details so that I teach you how to know what are the auditor's responsibilities. Just 1 minute. So I want to teach you the auditors about the auditor's responsibility. Alafu tukiangalia your question, you will be the one telling me how we should go about it. So that is now what I was talking about under adjusting events. Be very keen. Number one, we might have the year ending on 31st of December 2020. Sometimes they can give you any month, even June. But let's take 31st of December 2020. Now, after this, the year has ended. We have January. Then we have February. Then we have March. Then we have April. Then we have May. Now, this month, they have from January from first to the end of the month, This one is basically now 2021. We are talking about 2021, January, February, March, April, with their respective dates. Now, after the year end, that you can be maybe you are going to do audits. As an auditor, you are going to do audit in March. Let's take example March. It relates to the audit. So you have to be very keen. It relates to the audit that you're going to do. Now let's take example that you're going to do audit here. On 31st, maybe on 5th, that is when you started audit. 5th of March, you are at the client place, you are doing audit. You've done audit up to maybe 10th of March, only 5 days. End of audit. Normally, after the end of audit, we have some other activities that will take place. You've done an audit, after 10th of March, you now go back to your office and start looking at the financials. You are doing a review. We have looked at reviews. You are going to review the report. Now, at that time, things can happen. By the time you are reviewing, somebody can actually call you and tell you that, when you are at the field, some of the things that you are seeing have changed so far. Yule creditor amekufa. Wewe ulitoka kwa field akiwa mzima, alikuwa high. But now vile umeleft, amekufa through road accident. It is now becoming a bad debt, but it was just a good debt initially when you are there. So things change, and those are also subsequent events. They are happening after the year end. So let's say that here, you are going to review the audit, and then you give it to your partner. The person who needs to sign the report is the partner. So you are supposed to give it to the partner to review. After the partner has looked at it, he will give it to the directors of the company, to the client, the director of the company that you are auditing to sign. It is only after the directors have signed that the partner can also sign, but they have to indicate the dates. So in the example, they might mention something like signing date or the report date. That is the date when the directors signed it. That is when the financial become active. The directors are the ones to sign first before the auditor, because that is their books. They have to show, lead by example, sign and show responsibility. Wakisha sign, then now the auditor is at peace. Yeye pia anaweza sign aseme kama hao wenye vitabu wamekubali iko sawa, then hata mimi sasa naweza sign. But the auditor will not accept to sign if the directors have not signed. Hawatakubali. So the rule is one, the directors sign. If the directors have not signed, they will be now doubting. Why are they not signing their books? So let's say that it's 10. Then the signing date is on 5th of April. That is when the directors sign. After signing date, the only thing that is remaining is that the partner will sign. They can sign on the same day or even a day after, but they will sign anytime soon. Wakisha sign, we are now waiting for AGM. That is annual general meeting for the members to be able to look at the report. So AGM is actually in May. AGM. So I've done an audit. I took the number of periods that were possible. We'll review all that day that is remaining. Then on the 5th, the directors have decided to sign. Immediately they have signed, it is assumed that the partner also signs. After they have signed, now we are going for a GM that is scheduled on 10th of May. After AGM, story of books imeisha, we now continue with life. The audit process is done, meeting is held, we are continuing with life, waiting for the next audit. We are only waiting for the next year's audit. Tuko pamoja? Now, these are the events that these are the activities for the audit process. So these are the activities for audit process. Now, if any event happens here in January, if any event happens in January that has impact on the financial year, remember January and February, the auditor has not come. The auditor came in March. So any event that happened here, these guys should be able to change or adjust in the books. When they were closing the year, they had their financial reports that were already adjusted. They were able to close the books. But something that has happened before the auditors come, they need to adjust. So if they have not adjusted, the function of the auditor or the role of the auditor or responsibility of the auditor is to advise them to adjust. Kazi ya auditor ni kuambia wa adjust because they have not adjusted. For example, by the end of the year, maybe debtors or receivable were 10 million. In January, one of the debtors paid, or no, he has failed to pay. One of the debtors have done what? Have actually lost. Maybe he has been declared bankrupt or he has died. So it means that we have to adjust here so that we don't show in the books at the AGM. We don't want to show the books at the AGM at a receivable 10 million. Now, ukweli, we know that we cannot receive 10 million. Mtu alikufa na akakufa na 5 million. So we lost 5 million. So the best thing, before the auditor comes, before we go to AGM, we need to make the books reflect the true position. What is the true position? Tunatoa hii from here in a back 5. So we only report receivable because that is what we can receive. Receivable and are debtors. Then the other amount we need to adjust in the books. So now, just 1 minute. A student is calling. 1 minute. Yes, sir. Hello. Sorry. Now, this one you need to adjust. The same thing here. Now, during audit, it can also happen when the auditor is in the field. Auditor anapata information wakati yako kwa field, anaambiwa unajua mtu amekufa. Anaangalia report, anaona one of the clients died with money. Kama hajalipa, he can actually advise. So the activity here again, advise the management to adjust the figure in the financial report. Remember at this time, if it happened here, between the date of audit, kabla auditor toke, the auditor had not given any audit opinion. At that time, he was still auditing. Now what he can do, he can check from his audit program. If he had audited that place, he will advise this guy to adjust, then he can go back to re-audit. That is what we call, you perform audit procedures. Unaangalia the implication of that adjustment in the areas that you have done. Ulikuwa ushafanya. What is the implication of that particular adjustment? Then you adjust. If you have not done audit there, fine. They will just adjust, then the auditor will do normal audit in that particular line item later. Now, the same thing can happen when the auditor has left the field. The auditor alitoka from field on 10. The event happened after 10, towards the end of the month. Here, if it doesn't happen here, after 11, or maybe 11 going forward, remember the auditor had collected some audit evidence. He had audited that particular area. where the subsequent event is, he needs to advise these people to check. The auditor can look at the implication on his audit evidence and the report that he got from the field. He can even go back to the client premises to perform other audit procedures. But if he doesn't have significant event, he can adjust from wherever he is. But if he feels that it is important for him to go and do further audit in the same area, he can go and perform other audit procedures to come up with the right position as at that moment after the adjustments. Because he had done that audit, he had left the field, he had left the client premises. So in case of such things, he needs to go and perform audit procedures. Now, it can happen when the report has been signed by the directors. Yani umefanya audit ukamaliza, ukaconclude, ukapeana opinion. After giving the opinion, the report has been prepared. Now the directors are signing the report. After they have signed two hivi, unasikia ati kuna change. Somebody is telling you that you need to amend. There's a problem, you need to amend. Imagine the directors have signed the report and you've given an opinion. As an auditor, you don't have the authority to change or to amend the financials. You only tell these people, the directors and the management, to make such changes, adjust such changes in the financials if they are adjusting events. If they are not adjusting events, you only disclose. You tell them that you need to disclose those changes in the financials, but you don't adjust. Yani, unaweka tu wazi, watu waone, but you're not changing any figure. So in your report, you can put it as part of the basis of audit opinion, or you can put it as part of the findings or key audit matters. It depends on where it is, but you need to disclose that one. You need to disclose it. Or you can even put it except for opinion as part of the items that you are seeing that you needed to mention. That is what we call emphasis of matter paragraph. You need to include it in a line called emphasis of matter paragraph. It is a paragraph where you are going to put things or emphasize on some of the things that you feel management or the users of financial information needs to take notice of. You emphasize on that line so that they can take note of that particular line. It is called emphasis of matter paragraph. It contains things that are not adjusted from financial information, probably, so lazima zikuwe adjusted, but the things that you want to bring to the attention of the users. That is the content of emphasis of matter paragraph. It is normally when you are able to see the basis of audit opinion, just after the basis, you can have emphasis of matter paragraph below it. You say emphasis of matter paragraph, then you explain. Those are some of the things that you wanted to bring to the attention of the client, or the users. Now, you advise the directors to go and change, even though they have signed. But some directors will be very alarmant. They will tell you, Dennis, I cannot change the report. We have signed and we are not changing. The reason why they might not change is, number one, the current report that they have signed is a good report. If they change it, you are going to give them a bad report because the implication is bad. So they know, as directors, they don't want to be seen as bad. They don't want their financials to look bad. Wanakataa, wanakwambia, no. We have signed and we are not signing again. Let that report just go like that. As an auditor, if they have refused to change the figures on the financials, they have refused to adjust, you need to write a disclosure statement. Say, I've actually advised these guys, but they have refused to change. This report is not legit. This one is a fake report. I'm not part of it. Hata kama ulikuwa umesign kama auditor, unajitoa. That's number one. Number two, you can report the same to the regulator. If these particular financials were for SASRA or they are for CBK or for any regulator, write a note and tell them that there is a subsequent event that needs to be adjusted. There's an adjusting financial subsequent event that I have actually advised these guys to change. They have refused. And so they want to present this report the way it is, which is wrong, to the AGM. Please take note that this report is not valid. You can report. Another one, you can also look for legal implication. You can ask your legal advisor, like lawyers, ask them, what will happen if this report goes like this to AGM? What will be my liability? They know that in this case, you can be sued and you are going to pay this much because you lied on this report. So get an advice from legal experts so that they can tell you the amount of liability that you are actually exposed to. But what is important? Detoy, write a letter to disown the report, write a copy to the relevant regulatory authority. So, and if possible, your regulator, like ISPAC, they can also follow you and say that you gave a wrong report. You can be licensed, you can be denied license. You can also write them a letter and inform them that you did audit like this, but the plan does not have integrity. It's putting you into problems. So you can also disclose that to your regulator so that you become safe. Nobody is going to use that report. The next thing that you can do, make sure that you go to AGM. Wakati wa AGM, wakipresent you fake report, go to AGM. We say that one of the rights of the auditor is that they have to be given the responsibility to speak at the AGM. When you are given that chance to speak, tell the people that are there that this report is fake. I actually told these people to adjust. This is the current report that should be right. They have refused to adopt it. Inafaa ikuwe hivi, wamekataa kuadopt. Hii ingine ni mbaya. When you are going to speak there, tell the people the truth. Those are some of the ways you can actually avoid getting into problems when the report is bad and they have refused to adjust. If they agree to adjust, remember they had signed. If they agree to adjust, just go and confirm the implication of the adjustment on the financials and change the audit opinion if necessary. The implication might actually force you to change the audit opinion, change if necessary. Tuko pamoja? Okay. So what about when it happens after AGM? They have signed, but now after AGM, ndio unasikia kuna shida. What do you think? At that time, you just have a meeting with the management first, the board of directors, discuss with them so that they can tell you how they want to treat such kind of events. What are they planning to do? Mwaji imemwagika. Things were bad in the financials. You presented a wrong report. You only realized later that report doesn't represent the true and fair view. But you gave, assuming it represents true and fair view. So for problem already. Discuss with the management and tell them the implication. Ask them how they are planning to treat that particular issue. Number two, give a note, a copy, leave with the management. But you can also send a copy to the regulator, tell them that this report that we are sent to you after AGM has an issue. That is also another way. Then you can also send disclaimer that a notice so that in case somebody wants to invest in this business, they already get a disclaimer that you don't own that report, fully reject. Because when somebody wants to invest, they will always contact this company and say that we want to buy your shares. We have seen you are doing well. We want to buy your shares. If you have given them a notice, then it is now their responsibility to let the client know that, okay, you like our shares, but we cannot give you now. There's a problem. Maybe we can communicate later. Let them now take the responsibility of advising those who want to invest with them after the AGM. Those are subsequent events. They follow each other. The keyword here, advice. Whenever there is adjustment to be done, you advise and perform audit procedures. Adjust, do additional audit procedures until the end. Until where they have resigned, but they are refusing. That is when you now look at other ways of protecting yourself, because already you are in a shit, you are in trouble. Let's look at a question that our friend has shared with us. The time is not on our side, but I'm happy that you understand what is needed. In case they bring any question now, you should be able to understand what is happening. The treatment, those are the treatment or the responsibility of the auditor in each stage. So you tell them, advise the board to adjust, then reperform audit procedures and gather additional evidence so that you can change the opinion or conclusion where necessary. That is how you keep on moving. Hadi wakati wamekata kuadjust. Hapo sasa, there are more responsibilities that we agreed on, and I hope you have written them. One of the responsibilities when they have refused is that you write a notice to disclaim or disown the report. Number two, send a letter of that disclaimer or withdrawal to the regulator. Number three, you can send the same to your regulator, which is ISPAC, notify them so that in case of anything, let them not accuse you that you are negligent. Number three, make sure that you present yourself in the AGM and make clear the true position. Tell the people. Those are ways in which you can actually prevent yourself from trouble when they have refused and they will insist that they want to give a wrong report at the AGM. Let's now look at the question. Okay, very fast because of time. I'll just read very fast. You are the auditor. You are the auditors of Tambaa Mattresses, a company involved in a bulk production of mattresses for sale to the individual customers. The company's year end is 31st December 2020. That is the year end. So, ukiona kitu kama hii, unaanza, I'm not sure if you can see me, but I believe you can. Unaanza kuandika hii. Ukirealize to the subsequent event, just draw something like this. It ended in 31st December 2020. I've written that. So that is the year end. That is the balance sheet date. Fine. Assume further that the following information has just been availed to you before the audit report is signed. Good. This ones came before the audit report is signed. Number one, the springs in a new type of mattress have been has been found to be defective, making the mattress unsafe for use. There have been no sales of this type of mattress. So imagine after the year end, that is when they are realizing spring shida. But the good thing is they have not sold that mattress. So we don't think there is a client who will come and claim. That means that the risk is quite low already. It was due to the market. It was due to be marketed in the next 4 years or 4 weeks. The company's insurers estimate that inventory to the value of 75 million. Sasa, by the end of the year, the company's insurers estimate that inventory to the value of 75 million has been affected. So, under stock, remember, at the year end they had stocks. The stock has an issue 75 because of spraying your mattress, shida. So amount of stock that you're not going to sell, those are the inventory, the mattresses. 75 million has been affected according to the insurance. 75 million has been affected. So this one should not be part of stock. You cannot sell it. You only buy stock, even though that is what they are reporting, that it was part of the stock. We know that the total amount of stock, 75 million, shida. So it should not be part of the stock. So the insurers are also estimated that the mattress were now only worth 22.5 million. Right now, the good mattresses are only 22.5 million. 75 million shida. Though that is what was in the financials. That means that this one is a bad mattress. The only good one that should be considered is 22. So good. So this means that the total that was reported in the financial was the total of this. However, by the end of the year, they didn't know that this is a problem. So they had the total of these two, which is 77.5 that was reported in the financials. Now out of 75.5, 75 million, this one is, no, 97, sorry. 97.5, 75 million shida. So the legit one that should be reported is only this. They should have reported 22 only, 22.5. No claim can be made against the supplier of the springs as the as the supplier is in liquidation with no prospect of any amount being paid to third parties. A good case story. The supplier who supplied the wrong mattresses or the wrong springs, you cannot go and claim from them. You are going to lose this money. That is why they are telling you that this one is a loss. This guy is reported 97.5, only to realize that 75 is shida, which means that they cannot even claim it anywhere, though they have reported it under stock. So you have to write it off as bad stocks. That is a loss, damages, right? And you can't claim it anywhere because the person that you're going to claim from, the supplier, has been declared bankrupt. Ye mwenyewe hana kakitu. He is in liquidation with no prospect of any amount being paid to third parties. He has been declared bankrupt. He's being liquidated. Now, the insurers will know that the insurers will not pay Tamba mattresses. Insurance pia amekataa, we are not paying this amount. The supplier also cannot pay this amount. That is a clear loss. Now, the reduction in value of the inventory as the company was underinsured. Okay, so they didn't even insure this. All this inventory was in the finished goods store at the end of the year, and no movements of inventory had been recorded post year end. So all these were here at the year end. There is no change of movement has been made, meaning that this one is what they are reporting in the financials. They are reporting 75 that is wrong, plus 22 that is bad, total 97. In the financial statement, they didn't make any adjustment and there were no sale. That is what they are saying. Actually, all of these inventories was in the finished goods store at the end of the year, and no movements of inventory has been recorded post the year end. With reference to the above implication, or with reference to the applicable international standards on auditing, determine whether the above event is an adjusting or non-adjusting. What do you think it is? And you explain. That is why it is 3 months. Tell us why you think it is adjusting or non-adjusting. Alafu 3 months. Should we adjust it? At the year end, wamereport hiyo. Hakuna kitu imefanyika. They only realize later, before the audit, after the year end, that this one has happened. Assuming further that information has just been available to you before the audit report is, ukiona tu wanasema, you know, if you want to know when did you get this information, unaangalia statement. Wanasema, assuming further that the information has just been available to you before the audit report is signed. Wakisema tu before it is signed, hao watu wamefika huku. They were supposed to sign, meaning that you have left the field, you've done audit, you are about to let it be signed. In fact, they should have told you before you've gone for audit, but now they are telling you before it is signed. That means that you've done an audit, umerudi kwa ofisi, the client is about to sign. So in the financials, all those things that umebeba in the financials under inventory, ziko na figure inakaa kama hii. Somebody is trying to tell me something. What do you think? Adjusting, it will have an implication on the financial report. Nice. Let me start with this. Somebody is adjusting events. Yes, adjusting. We agreed, adjusting. So explain. It affects stock quality, but no movement of inventory. Then it is an adjusting event. Any other trial? Any other trial? So these are damaged stocks. These are stocks that you cannot sell, right? If you are a good person, we know very well that this stock is of low quality. They are damaged. And they ended up telling you that the client is not willing to pay for that damage. And the insurance is also refusing, saying that you undervalued the report. Wanasema you underinsured the stocks. So meaning that this one is a direct loss. This is now where we call it bad stocks. So it is an adjusting event because it was reported like this in the financial year end. But then part of it is not in a position to be sold. So we can't count it as part of the stock because you will not sell it. It is not true that you can sell that. So it is an adjusting because the presence of 75 million, which is a bad stock, is of low quality and we cannot sell it. You cannot realize that amount. So if we report this one as 97, we are overstating the stocks. We will not sell that stock. We are overstating. Inafaa tutoe hii tubaki na the one with the right quality. Hii tumepoteza. We cannot sell it, we cannot be refunded because the supply is liquidated, and we cannot be compensated by insurance because we underinsure. Kitu kama hiyo, alafu tunaenda kwa the second question. Discuss the auditor's responsibility and the audit procedures and actions that should be carried out in the above scenario. So auditor's responsibility. Now, umeambiwa hii story when you have done an audit, you are about to sign, right? They were about to be signed. So, kwa katikati, you left the field, you are about to sign. So, one of the responsibility, the auditor needs to assess the implication. That's for number one. In fact, now it is 10 marks. 10 marks ni mingi, unakuwa mbora. Number one, you need to identify whether it is an adjusting or an unadjusting. That is number one. Because we want a lot of marks. Ni 10. Sio mchezo. So the first auditor need to determine whether it is adjusting or non-adjusting. Usiache marks mengi. Na hii, because it has a lot of marks and people don't understand it, they will give you a lot of marks with few points, but try to put as much as possible. Now your role number one, your role is to determine whether it is adjusting or non-adjusting. That's number one. Number two, assess the implication on the financial statement. Implication of the adjustments on the financial statement. Cynthia, after knowing the implication, already you are left the field, the auditor can reperform the additional audit procedures. Reperform additional audit procedures or perform additional audit procedures. To determine, you can perform additional audit procedures to determine whether it is important that you change or you collect further evidence. You can even talk about audit procedures, then you can write another line. The auditor can collect more evidence to come up with the right report. So you talk about more evidence. Yeah, to come up with the right report. Then now, the auditor needs to assess whether it is necessary to adjust his audit opinion and conclusion. Umeona vile hizi points zinakuja. Walikuwa nakupea 10 marks wanakupima. Na sasa umeanza kuziweka hizo points zinakuja. So even if they say audit procedures and actions, wewe mwaga zote, mix them, let them go and choose which one is the audit procedure, which one is the action. Right? So you perform audit procedures. Which kind of audit procedures are you perform? You recount. When you talk about performing audit procedures, you can explain that the auditor can recount. You recount the stocks, physical inventories. Then you look at the criteria they are evaluating to check whether the quality of these mattresses can be treated as bad, so they cannot be sold. What are the criteria they're using to say that these ones are unworthy mattresses for sale? And then you ask the management, how do they treat bad stocks? You have performed that procedure. What is their policy on how you should treat bad stocks? Those are audit procedures. Unaona, recount, check on how they look at the quality, criteria they use to look at the quality. Then confirm how they treat bad stocks in their books. Then check whether they have adjusted on the right way in the books. Angalia kama wameweka vizuri vile wali advise. Those are audit procedures. Then you now come collect more evidence or new evidence. Then check whether the new evidence can actually have implication in terms of the conclusion, whether you need to change the conclusion. So that is action. You check whether you need to change conclusion on the audit report. Alafu, redraft new audit report. That's the last thing. Draft a new or give a new audit report. Alafu sasa, unapeana tena for signing. or you ever reevaluate. You evaluate and review the whole audit process again, then you give a new report, upeane for signing. In fact, with this, they only need you to identify like 5 things. Okay, let's state vizuri. Like now, if you say determine whether it's an adjusting or non-adjusting events, then you can explain how you need to check. And adjusting events have financial impact on the figures, while non-adjusting events have this. Then you go to the second point, because at the end of the day, you need these 10 marks. Na wewe umecheck ukaona hii marks ni mingi, huwezi cheza na marks. Lazima umwage points as much as possible, and you follow them in that order. Are we together? If you allow me, today we have done adjusting events. Let's tomorrow pick from joint audit. We look at the advantages, definition, disadvantages, and things that you should need to consider. After that, we can look at expert opinion. Sawa. What if the same happened after the report has been signed? That one I explained. What you simply need to do, now you explain this. After explaining this, you say that after the report has been signed, you advise in fact, you follow the same procedure, but then you say one thing that you can never forget. I don't know whether I've indicated here, whether it is adjusting here, you need to indicate here, advise the management to adjust. Advise the board, advise the management, advise the board of management to adjust. After that, after adjusting, you now assess the implication of the adjustment on the financial statements. If it needs further audit, you go back now and perform audit procedures, explain the audit procedures, get more evidence, then now let them sign again. So that is the only thing that you're going to add. Let them sign again. Marks is the same procedures, same performance, but they knew one thing. That is why they are giving you more marks. That in this scenario, you needed to go and do other audit procedures. You needed to have gone back to the field and perform other audit procedures. Why? Initially, you counted the stock, but there was no bad stock. So it didn't come to your mind to know how they are treating damaged stock. But now that you have this in your knowledge, that there is a damaged stock, one of the audit procedures that you're going to perform is to know how they are treating damaged stock. How do they treat them? Which criteria do they use to identify that this one is a bad one, this one is not a bad one? Probably, even those bad ones, they have a procedure. They can say that bad ones we can sell at 100 shillings and not 200. Probably they have that. But either way, they have not mentioned at this time. So you are going to write off the whole amount. You are just in the books. So you need to write off. But now every company has a criteria of treating damaged stocks, or even disposal. If it was disposal, there is a criteria of treating disposals. So that is one thing that when you're doing audit, you need to ask them. Hapa kwenyu mnafanyanga aje wakati kuna kitu kama hii imefanyika? How do you go about it? That is one of the big procedures. Then you collect evidence. So. Thank you very much. I hope that one can help your neighbor and you as well. That information that I've given you can help you and your neighbor. Any question? Any question on subsequent event? If you have any question, even in our next class, you bring it again. I'll be able to assist. So. Otherwise, see you tomorrow, same time, same place. Lipa mapema, uingie class. So. See you. I love you all.